November 2022, what looked like a safe harbor for crypto investors collapsed. Withdrawals froze, accounts stalled, and billions of dollars could not be moved. At the center of that collapse was one named Samuel Bankman-Fried. People called him SBF. He founded FTX and Alameda Research. He was celebrated, and now he is convicted. How does a company go from darling of the market to bankruptcy in a matter of days? How does a founder go from hero to felon? We trace that arc, we follow the clues, we look at the choices and the blind spots that allowed it to happen. Sam was born in Stanford, California in March 1992. His parents were both academics, law professors. Ethics and public policy were part of everyday conversation at the dinner table. As a child, he loved math. He loved games. At MIT, he studied physics. He found a philosophy called effective altruism, the idea that you can do the most good by earning a lot and giving it away. He took that idea seriously. He called it earning to give. After college, he joined Jane Street, a quantitative trading firm. There, he learned how fast money moves and how markets bend. In 2017, he founded Alameda Research, a crypto trading firm. Alameda profited by finding tiny price gaps across exchanges. It made real money. That success planted a seed. In 2019, he helped create FTX, a user-friendly crypto exchange. The pitch was simple, safe, fast, and built for traders. FTX issued its own token, FTT, and it grew quickly. The company struck deals and bought splashy sponsorships. Tom Brady and Gisele Bündchen were associated with the brand. Larry David starred in a Super Bowl. FTX bought naming rights and sponsored a Formula One team. Sam hosted high-profile gatherings in the Bahamas. He met former presidents. He donated millions to political causes. Publicly, he looked casual. Shorts, t-shirts, late nights, a beanbag at the office. The image was of a laid-back genius. The message was serious. He was building a better financial system. Underneath, the structure was more complicated. FTX was an exchange. Alameda was a trading shop. On paper, they were separate. In practice, later records showed their finances were tangled. Alameda held massive positions in FTT. Alameda used FTT as collateral. That created a dependence. When FTT had value, the balance sheets looked healthy. When FTT lost value, weaknesses were exposed. Concentration replaced diversification. Risk multiplied. Then, in early November 2022, a leaked balance sheet changed everything. CoinDesk reported that Alameda's assets included billions in FTT. People noticed. On November 6, Binance, the world's largest exchange, announced it would sell its FTT holdings. That announcement became a signal. It triggered fear. Users rushed to withdraw funds. Withdrawals surged. Fees could not meet the demand. Withdrawals slowed. The company paused redemptions. Emergency financing was sought. Within days, the company filed for bankruptcy. The collapse moved faster than most explanations. Investigations that followed painted a harder picture. Customer funds had been redirected. They financed Alameda. They paid for political donations. They bought luxury real estate. Money moved between entities with few guardrails. Customers had expected custody. Instead, they found opacity. Corporate governance failures were central. Boards lacked independence. Oversight was shallow. Controls were weak. Those structural gaps allowed risky choices to amplify, and the founder's public narrative, charisma, publicity, political donations, obscured warning signs. On a personal level, Sam presented himself as an idealist. He spoke about protecting humanity from catastrophic risks. He said he wanted to earn to give. He built a reputation as a donor and a thinker. Yet his private life told a different story. He lived in a $30 million penthouse in the Bahamas with employees. Caroline Ellison, his former partner and a key Alameda executive, later described how funds flowed between FTX and Alameda. Her testimony mattered. It was pivotal. Prosecutors assembled evidence. They charged Sam with fraud, conspiracy, and money laundering. The trial focused on whether he knowingly misused customer funds. In November 2023, a jury found him guilty on multiple counts. The sentence? 25 years in prison. The man who once appeared on billionaire lists now faces a long term behind bars. The scale of the losses stunned investors. At its peak, FTX valuation reached tens of billions. The collapse wiped out confidence overnight. Regulators moved. Some governments accelerated efforts to regulate crypto. Exchanges tightened controls. Celebrity endorsements and flashy marketing no longer masked risk. The industry faced a reckoning, but the courtroom verdict is only part of the story. We have to ask deeper questions. Was Sam a misguided idealist who lost his way? Or was he a calculated operator who built an illusion and sold it? He framed his work in moral terms. He talked about saving the world. Yet the actions revealed in investigations show customer funds used in unexpected ways. Intent and consequence didn't line up. For investors, the lessons are direct. Demand proof of custody. Ask for third-party audits. Understand counterparty risk. Don't let charisma substitute for transparency. For boards and regulators, the lesson is structural. Enforce independent oversight. Require clear disclosures. Protect retail investors from concentration and opaque intercompany practices. FTX taught us something painful about modern finance. Trust can be engineered with code and marketing. But trust, real trust, must be backed by clear, verifiable practices. When systems lack transparency, faith becomes fragile. Narrative can move markets, but without method, narrative collapses. This story isn't unique to crypto. It echoes older collapses, where the story outpaced the facts and status obscured scrutiny. The pattern repeats. A founder crafts a compelling vision, investors rush in, regulatory gaps persist, and then the cracks show. Sam Bankman-Fried changed the conversation about crypto. He forced regulators, investors, and the public to confront how we assign trust in new financial systems. He showed how narrative and power can amplify risk, and he showed how quickly that risk can become real harm. So now I want to hear from you. Was Sam Bankman-Fried a misguided altruist who lost his way, or a fraud who betrayed the public's trust? Pick a side. Tell us the single fact that convinced you. The most thoughtful replies will be pinned. If this deep dive helped you make sense of the collapse, like and subscribe. We'll keep pulling back the curtain on the empires that shape our world. Thanks for watching.